Ever wondered how traders predict future price movements? It's not magic, nor is it pure luck. It's a method called technical analysis. This is a financial tool that involves scrutinizing past price and volume data to forecast future movements. Imagine having a crystal ball that, instead of showing hazy images of the future, presents detailed charts and patterns. That's technical analysis for you. Traders use this tool to identify trends, decipher patterns, and spot trading opportunities based on the dynamics of price and volume. It's like reading the market's pulse, understanding its rhythm, and predicting its next move. From candlestick charts to moving averages, and from support and resistance levels to the MACD and RSI, these are the tools of the trade in the world of technical analysis. So let's dive deeper into the world of technical analysis. At its core, technical analysis revolves around analyzing historical price and volume data. It's an art and science that traders use to forecast future price movements. So how does it work? Let's break it down. Technical analysis is a method of predicting the direction of prices through the study of past market data. Unlike fundamental analysis, which looks at a company's intrinsic value based on factors like earnings, economic indicators, and industry conditions, technical analysis focuses purely on statistical trends derived from trading activity, such as price movement and volume. Picture this. If you're a surfer, you'd study the ocean's current, tides, and waves to decide when and where to surf. Similarly, traders use technical analysis to study the market's waves or trends to determine when and where to trade. So what are these trends? Well, they are essentially the direction in which the market is moving. Trends can be upward, downward, or sideways. Identifying these trends is key to making informed trading decisions. Now let's talk about price and volume data, the two key components of technical analysis. Price refers to the cost of a specific asset at a particular point in time. Volume, on the other hand, refers to the number of shares or contracts traded in a security or market during a given period. Price and volume data are typically depicted on charts, which provide a visual representation of these trends over time. Charts are the canvas on which technical analysts paint a picture of the market's potential future movements. It's important to note that technical analysis is not a crystal ball that can predict the future. Rather, it's a tool that can help traders identify potential trading opportunities based on statistical trends. It's all about probabilities, not certainties. Having understood the basics, it's time to explore the tools traders use. These include fascinating things like candlestick charts, moving averages, and even invisible walls known as support and resistance levels. But that's a story for another scene. Chart patterns and candlestick analysis are essential tools in a technical analyst's toolbox. As we navigate the world of technical analysis, it becomes clear that patterns can act as a roadmap, guiding us through the market's twists and turns. Let's talk about some common chart patterns first. Imagine these patterns as the footprints of market psychology, each one telling a story of supply, demand, and trader sentiment. We have the head and shoulders pattern, a classic sign of a looming trend reversal. It's like the market is shrugging off its previous trend and preparing to head in a new direction. Then there are triangles, which can be ascending, descending, or symmetrical. These patterns represent a period of consolidation before the price breaks out, signifying a continuation or reversal of the existing trend. And let's not forget about flags and pennants, small pause patterns that usually signal the market is merely catching its breath before continuing its previous trend. Now let's shift our focus to candlestick analysis. Originating from Japan over 400 years ago, candlestick patterns are a popular tool among traders due to their visual appeal and ease of interpretation. Each candlestick represents a specific time period and shows the opening, closing, high and low prices during that time. The body of the candlestick represents the range between the opening and closing prices, while the wicks or shadows show the high and low prices. Certain candlestick patterns can hint at potential market changes. For instance, the doji, where the opening and closing prices are virtually the same, often indicates indecision in the market. The hammer, with its small body and long lower wick, can suggest that the market is trying to hammer out a bottom. Remember, though, that these patterns are not foolproof predictors of future price movements. They are merely tools to help you make more informed decisions. As with any form of analysis, it's crucial to consider other factors and indicators before making a trading decision. These patterns offer valuable insights, but they're just one piece of the puzzle. Technical indicators act as guiding lights, helping traders navigate the market's choppy waters. They are like the North Star for sailors, providing direction when the path ahead seems uncertain. Let's begin with moving averages, a fundamental tool in the technical analyst's arsenal. These are calculated by averaging a certain number of past closing prices. The result smooths out price data, revealing underlying trends that might otherwise be obscured by market noise. Moving averages come in various types, including the simple moving average and the exponential moving average, each with unique characteristics. Next, we have the moving average convergence divergence, or MACD. This indicator involves two moving averages, one short-term and one long-term. When the short-term average crosses above the long-term average, it's a bullish signal. Conversely, when it crosses below, it's a bearish signal. The MACD helps traders identify potential buy and sell opportunities based on these crossovers. The Relative Strength Index, or RSI, is another popular indicator. It measures the speed and change of price movements on a scale of 0 to 100. Generally, an RSI above 70 suggests an overbought condition, while an RSI below 30 indicates an oversold condition. The RSI can help traders spot potential price reversals and gauge the strength of a current trend. These indicators, along with many others, serve as valuable tools for traders. They provide insight into market trends, measure momentum, and help identify potential trading opportunities. But remember, no single indicator can provide all the answers. They should be used in conjunction with other tools and analysis techniques to increase the likelihood of successful trades. With these indicators, traders can make more informed decisions. But there's more to it. In the world of trading, support and resistance levels are like invisible walls. These are price points on a chart where the probabilities favor a pause or reversal of a prevailing trend. But how do they work? Let's delve into the details. Support and resistance levels are the cornerstone of technical analysis. A support level, as the name suggests, is a price level where the asset tends to find support as it falls. This means the price is more likely to bounce off this level rather than break through it. However, once the price has breached this level by an amount significant enough to convince traders that the support or resistance level will not hold, it often switches to a new role. A former support level will switch to a new resistance level and vice versa. On the flip side, a resistance level is where the price tends to find pressure as it rises. Traders eye these levels as benchmarks to plot their trading strategies, setting their sights on these invisible walls to make informed decisions on when to enter or exit a trade. These levels are not set in stone. They shift and evolve over time in response to changes in supply and demand. Identifying these levels and understanding their potential impacts can help traders manage risk and make more informed decisions. Support and resistance levels are not just abstract concepts. They're very real, and they have a tangible impact on market trends. By understanding these levels, traders can identify potential opportunities and better anticipate future price movements. But remember, while these levels can provide valuable insights, they are not foolproof. Price can break through them and continue on its trend. That's why it's crucial to use these levels in conjunction with other tools and indicators in your technical analysis toolbox. In essence, while invisible, these walls of support and resistance provide a structured way to view the market chaos and a lens to dissect the seemingly random ebb and flow of prices. These invisible walls help traders plan their moves. But how do they bring it all together? The true power of technical analysis lies in its practical application. Consider a trader examining a forex pair. They may use candlestick charts to identify a head and shoulders pattern, signaling a possible trend reversal. With this insight, they could strategically position their trade, anticipating the upcoming shift in price movement. Or take a stock investor who notices a golden cross on a moving average chart. This bullish signal could prompt them to buy more shares, expecting a rising trend. Then there's the momentum trader who relies heavily on the MACD and RSI. Spotting divergence between these indicators and price can suggest a potential trading opportunity. These are just a few examples of how technical analysis comes alive in the real world. Different strategies, trend following, momentum trading, swing trading, all hinge on interpreting these technical signals accurately. And that, in essence, is how traders use technical analysis to predict future price movements.